Hello, everyone. Welcome back to the Rational Investor School for Trader Development. Dun, dun, dun.
Hello, everyone.
And we're live on YouTube. Looks like we're rocking and rolling there. That's good. Welcome back to class, all you God motors. This is our level 3 program. I hope you all had a nice Christmas break there. Hi, Center. Welcome back, indeed. Hi, Zach. Yeah, it looks like everybody's chiming in, saying hello. I had a great little chat before we got going here with our TAs, Raf and James. So we've got basically all the instructors and everything. Hi, there's James giving a big wave. And Raf says hello. Hello. I could probably spend 10 minutes going through saying hi to everybody. We'll just say, hello, everyone. Great to see you all back in class. This is our level 3 program, our advanced program. And interestingly enough, we actually left off before the Christmas break, introducing you to long option strategies. And if anything, it's probably not a bad idea that we give you lots of time there to digest those ideas. I know in particular, people like Zach here were coming up with just some fantastic trade ideas. And if anything, it's kind of cool for you guys because you've been given actually a really friendly market to go and find these ideas in. Like, this is a perfect setup. The whole stock market is just crumbled down, market panicking into the bottoms, everything just dumping, and all of a sudden long option strategies start popping up right, left, and center. On this site in particular, and we could probably walk through a couple if we have time here today. A couple other long option strategies, TRISOFs, presented themselves. So if anything, this is perfect time for you guys to practice this, to get out there and find these ideas. That's right. Your little oil stock, Zach, looks really interesting here. The great part about this, guys, like seriously, this is information that you can directly apply right away. You guys are in the level 3 program now, so I know that you understand how to work with trading plans and how to take appropriate risk. And the great part about options is that, we can go take positions for $100, $200, $300. You don't have to bet the farm. This can be an invaluable tool for the rest of your life. And also, too, what I've noticed, and I find this really cool, is TRISOFs are an excellent sort of proxy on, 3 unrelated reasons for consider taking a trade, because this is all about derivatives information. It has absolutely nothing to do with a price chart. It has nothing to do with company fundamentals. It is just purely what is the market's sort of, expectations going forward, and how does implied volatility play into that. And we all said, and we might as well start off with a little bit of review. But we said, and let's just see if we can play connect the dots. And I know you guys have been away for the better part of a month, so if you're a little bit rusty here, it's completely understandable. But should option purchasers be looking at high implied volatility or low implied volatility? And the TRISOF is your formula for sort of figuring that out. If you can answer the first question, then you should understand why TRISOFs work as well as they do. So here we are, and I've updated the schedule because I had that trip down to LA in December. Things got kind of screwy there a little bit. I apologize, guys, but nonetheless, we're back in the saddle here. So here is our first class, the 5th of January. Happy New Year. Woohoo! And it looks to me like the program's going to go right through to the end of March. So just be aware of that. Final exam will be that sort of last week of March. And if anything, that's not bad, because seasonally that'll sort of get us, transitioned into the spring coming out of this program. Thank you, Center. Low implied volatility is what we're looking for as options purchasers. I'm glad somebody remembered what I imparted on you there about a month ago about options. Here is our course curriculum, basically how we're going to walk through it, and we are right now at week 7. So we spent a week introducing you to options, trying to go through all the vocabulary and stuff. It's I understand it's a pretty thick slog. It's a whole new language that you have to learn. Then following that, we introduced you to a couple long strategy ideas, the TRISOFs, to help you understand the importance of low implied volatility when thinking about buying options, and a nice little formula Brian uses to try and make sure that I am buying low implied volatility with lots and lots of time. And then also we talked a little bit about buying multiple options and taking advantage of deltas to really expand our returns on positions. I don't know whether, actually James and I were sort of kicking around the idea of hunting TRISOFs in commodities. The problem that I have right now is that, very much like you saw with Bitcoin, are we at the cost of production for a lot of these commodities? And I still think the answer is no. We're very inflated, so I'm a little bit leery about delta option strategies in this kind of environment. But nonetheless, that doesn't mean you can't keep that strategy in sort of your back pocket. And of course, on the site, if we do have situations that arise that look like we're sitting at value or below, when I do talk about these strategies on the site, you'll understand exactly what I mean. And of course, if you do find assets that are flatlining, that are basing, that are just basically doing nothing, and you feel like we are sitting at value, maybe it's a stock, we're below book value. You can see directors are loading up. Maybe you get shares for debt kind of idea. We can consider delta option strategies there as well. So. Good to have those two strategies in your back pocket going forward. And like I said earlier, what I absolutely love about derivatives is completely unrelated reasons for considering taking trades. This week, sort of dovetailing, we're now going to look at the short side of options and options trading. Frankly speaking, I don't know whether many of you are actually at the stage of being able to consider short strategies. We're going to look at two different strategies. The first strategy we're going to look at is fairly common, and it's how most of the retail business plays the short options market. So you should understand the mechanics of this strategy. And then the second option strategy that we're going to look at today is very unique and very esoteric. My hunch is probably most of you won't be at the stage where you could even consider this, but this is excellent information for when you do build up a sizable account down the road and you'd like to use derivatives as a very low cost way to enter positions. Again, my thinking here is I want to fill out your tool belt. I want you to understand all the terminology, and I want you to understand why market participants do what they do in the derivatives market. And if anything, it's just simply a part of your knowledge base that I think is integral in understanding how markets work. And of course, that's the big part of this course and everything that I teach is I want you to understand the mechanics of the market versus going in there and making $1 million tomorrow. I mean, hell, we all want to make $1 million tomorrow, but a big part of this is just simply being an educated market participant and understanding the different players and how they act and why. So with that said, week 7 in particular, if we scroll down on the course curriculum, here we are, week 7. we all remember from the beginning of this introduction to options, and it's very unique in that every option has two participants to the contract. It is a contractual obligation between two market participants, and we talked about how every single market options options contract that's open up has to have a buyer that opens the position and a seller that opens the position. And in essence, they have to go into a mutually agreeable deal. This is a legal contract. So, unfortunately, a lot of people, fall into the trap of seeing the income of selling to open positions, because in essence you collect a premium for that, and they don't realize that there is a very real risk that you might have to honor that contractual obligation. And I think I've told you guys, in years gone by, I watched one brokerage house almost blow up because a university professor believed that writing put options was just a fantastic way of collecting income and making a lot of money. And his thesis was the stock market would never go down. And then, unfortunately, something like 1987 comes along and the market just falls out of bed. And it almost bankrupted the brokerage house. So, all right, so Raf says natural gas hedge fund guy was also not bad recently. Okay, not quite sure what you mean by that, but long and short of it here is, he blew up his fund with options. I don't know whether it was derivatives trading or not, but the long and short of it here is, options are open-ended obligations that can destroy some investors if they don't understand what they're getting into. It's probably not a bad idea for us to think back and maybe before we get into this in too much detail, think about our house scenario. We had originally made I don't know whether you guys remember this or not. I think, was it Raf? Was it you and I who went into a real estate deal together? I can't remember. Was it? Yeah. We had said that Raf and I were living next door neighbors in Corby. What a fantastic city that place is. And there was a big open lot next door to us, and we didn't know what the city council of Corby was going to decide as to what was going to be put in the empty lot. I was getting older, and Raf kind of thought that he's fairly flush with cash, and he was thinking, well, I'm in the market to buy another house, and so we agreed that I would write him a call option to buy my house. Prevailing comparable housing prices in the neighborhood were, let's say $200,000. And so we wrote Raf the option to buy my house at $200,000. And he paid me like $5,000 premium for that right. I think we agreed that it was going to be for like a 1-year duration. Now, this is under the assumption that I already own the house. If, however, I had actually gone ahead and sold the house already and I didn't own the house anymore, then what would we call this option? If I did not own the house and Raf and I went ahead and did this deal, and I wrote him the option on the house and collected the premium, that's right. This would be called a naked position. Extremely dangerous. We had a couple scenarios where, scenario number one was the city council decided to put in a golf course in the empty lot next door to us. And so as a result, real estate prices went zooming up for all the houses in our neighborhood. And let's say, just hypothetically, they went zipping up to $300,000. Braf had an option to buy my house at $200,000. And in essence, if I owned the house, then all right, Raf exercises the option and buys the house from me at $200,000. But let's assume that there's an exchange for these options and they're cleared on an exchange. And so as a result, there's a liquid market for these. Raf could literally go into the open market and sell that option for $100,000. In essence, the current market price for the property minus the strike price, which in our little scenario here, $300,000 minus $200,000 strike price equals $100,000. And generally speaking, when options are that deeply, quote unquote, in the money, they basically trade at intrinsic value. So interestingly enough, for RAF, if it's an exchange cleared option, then it's not really that big of a consideration. And if it's a liquid market, then he can go into the market and trade, hit the bid as it were. If, however, these are not exchange cleared, what do we call that kind of options transaction? Does anybody remember what the term is if we don't have exchange cleared exchanges functioning here? Three letters. First letter starts with an O. OTC. Very good, Casey. Very good, Philip. So the point here is if this was OTC, and keep in mind, before exchanges like the Chicago Board Options Exchange and stuff like that, all options transactions were OTC. And I had already sold the house and the position was naked. What's Raf going to do? The only recourse he has is to take me to court, right? So this is a big selling feature of why people like exchange cleared options, right? In essence, the onus is taken out of Raf's hands to take me to court and get the goddamn house, or the monetary equivalent. In essence, it's through the exchange cleared options scenario. The exchange now comes after me. Raf's basically he can go into the market and hit the bid. Not that big of a deal. And if he wants to exercise the position, the exchange will do the monetary value into his account. How these Bitcoin futures right now are traded in Chicago. They're all basically just financial transactions, and they all settle in US dollars, right? They don't actually settle in Bitcoins. And that's, that was one big criticism about this product, is that it really had, ironically enough, these Bitcoin futures actually don't really have anything to do with Bitcoin. They're really just trading off an index, and everything is cash settled. But anyway, the point of the matter here is I hope you appreciate how important it is for us to have this exchange clearing corporation, because if the other party on the other side of the transaction is naked, it makes it damn difficult for you to collect on this deal. Okay, so what I would probably could be, Philip, could be what I wouldn't mind doing right now before we get going in earnest is we should probably do just a little bit of review. So, as this slide, I like to work off of these slideshow presentations. This is how we're going to sort of, go through today. First off, let's do a little bit of review. So how many Greeks are there? Does anybody remember what the magic number of Greeks there are out there in the world? Uh-oh. Casey, very good. Shane, very good. Zachman, good. All right. So who can tell me what the, I remember good old Einstein and the chalkboard. Who can tell me what the time value decay Greek is called? There's a variable that measures the time value of an option and the rate of decay of that time value. What do we call that? Theta. Very good, Dave. Excellent. Excellent, Zachman. Excellent, Shane. Casey. Center. Very good. And we can remember theta by this exponential curve. And so as a result of this exponential decay in the time value of options, and we'll just make it really simple. If I wanted to, and this is what we covered before, if I want to be a buyer of options, do I want to concentrate on long-dated options that have a relatively low theta or a relatively low rate of decay? Or do I want to concentrate on short-dated options that have a very high theta or a very high rate of change? Right. Buyers want to concentrate on long-dated options where the theta issue isn't that big of a deal. And excellent, Crypto Shark. If you are a buyer of options, and in fact, a lot of portfolio managers follow this thinking, we actually want to buy options that have like years of duration. So you're not even, you can imagine that this curve becomes exponentially flatter the more and more and more farther out in time we go. And you can see this is just at 120 days. The rate of change, that theta influence, is relatively small. So as Crypto Shark lists here, if you are a buyer of options, you really want to concentrate on these long-dated options, which are called leaps. Or can anybody type out what that leap stands for? That's a tough one. If you guys can remember that, I'll be damn impressed. So let's see if anybody can actually remember what leap stands for. That would be like bonus points on the exam if you got that. Now, the exact opposite scenario, and today we're going to be talking about writing options, long something, something, something. Close. On the long-term equity asset participation. Oh, you forgot the last word. Securities. Way to go, Philip. Excellent. Philip gets some bonus points. Nice job, sir. So on the exact opposite scenario, if we are writing options, then we really want to concentrate on the short-dated options, because whatever time value there is in the short-dated options will decay at an exponentially faster and faster rate the closer and closer and closer we get to expiry. So if you write an option with a relatively short time life, and a big chunk of that option that you wrote is simply time value, then that time value will decay and disappear very, very quickly the closer and closer and closer we get to expiry. And as an options broker, God, I remember these days explicitly, right? And ironically enough, most of the money and most of the participants in the marketplace, they actually concentrate on writing options in this window. That's probably where about 80% of all options business is done. And we'll show you a strategy in a few minutes here, detailing exactly what it is that they do. Okay, so that's number one Greek. Now, we said that there is a Greek that tries to take into account the risk-free rate of borrowing money. I don't know. Does anybody know what the risk-free rate of borrowing money is called in the marketplace? There's actually a very specific reference, and I don't know whether many of you guys, I don't know whether we've really talked too much to you guys about this in the past, but there is a very specific reference to the risk-free rate in the marketplace. I don't see, oops, there's some people. Hey, whoop, I've stumped somebody. All right. So the risk-free rate in the marketplace is basically what the central bank is going to pay you to hold short-term paper. That's what the risk-free rate is called. And you probably should write that down. You know, if you haven't heard that before, that's a pretty important point here. The risk-free rate in the marketplace is whatever the central bank is going to pay on short-term paper, right? In essence, that is guaranteed. And really in the marketplace, that's the only guarantee there is out there. Don't kid yourself. A lot of people that invest in equities, for some reason, they believe that stocks have a guarantee to them, and they do not. As we all know, stocks can go to zero. The good thing about commodities, of course, is that they should bottom at whatever it costs to, you know, supply the commodity to the marketplace. So we said that, and let's all type up your answer here just so that I know that you heard me. We said that the central bank's interest rate that they're going to pay you on short-term paper, T-bills, 90-day paper, whatever you want to call it, is called what? 2 words, or 3 words, beg your pardon. Better make sure we get that right. Risk-free rate. Excellent, Zach. And Zach, like you're kind of guy, write that down, commit that to memory. That's something you need to know. Risk-free rate. Yeah. Okay. 4 words. All right. So the point of the matter here is options, because they have so much time value associated with them, they are going to be very sensitive to that risk-free rate. And what do we call that sensitivity? The options are very sensitive to a change in that risk-free rate. What do we call that variable? Excellent. Very good. That's row. Think of row, row, row your boat, right? Yeah, that's right, Dave. You got it. And I often like to do this where when we go through these reviews, and of course, next class we'll also be doing more options and derivatives conversations. So we'll go through all of this again next class. But the point of the matter here is rho is the effect on options prices with a 1% or any kind of change to the risk-free rate. Now, because the risk-free rate is so low right now, we don't really see a big difference in options prices given a change in interest rates. But we have to understand that that's not the environment that the market is always in. And when I was a kid growing up, we actually had double-digit interest rates. And you could have the Fed move interest rates from 13 to 14%, a full percentage point in a heartbeat. And then conversely, they could also move it down. All right, so we've talked a little bit about 2 of the 5 Greeks. Does Turkey do options? I'm not quite sure. Maybe. I would, and really, I guess the question is, what is the local derivatives market like there in Turkey? Does anybody even trust an exchange there? That's a tough one. Okay, moving on. So we've talked a little bit about 2 of the 5 Greeks. The other 3 Greeks are actually all very interrelated. Who can tell me what we call the effect on your options price with a $1 change in the underlying assets, either up or down? What do we call the effect on your options price with a $1 movement in the underlying? The delta. And really, the easy way for you can remember that is think rate of change, right? That's basically what delta means in math. All right, so since time equals money, and the rate of change of your option will greatly change given its proximity to where the underlying is and the strike price. Does delta move in a straight line? Maybe I better ask that again. Oh, okay, here comes some answers. No, it does not, right? In fact, it is this delta, and the way it actually changes given the relative position of your underlying relative to your strike price. This is the unique feature of options, and this is what makes things like that silver options insurance plan attractive, in that you can go and buy a number of options where if you add all the deltas of the current price together, and that comes out to 1-to-1. Let's say your option is moving at it has a delta of 0.25. So in essence, $1 movement in your underlying will translate into a 25-cent movement in your options price. And knowing that deltas ultimately want to expand to sort of that 1-to-1, where in essence, if an option is heavily in the money, a $1 movement will equate to a $1 movement in your options price. This is that unique feature of options. But there is something, okay, so we'll get to that in a moment, Hunter. There is something unique about options in that an at-the-money option must be the same value as what? Maybe we should, I'll ask that question. Let's see if you guys can figure that. An at-the-money option should trade at the same value as what? Yeah, excellent, Casey. In essence, an at-the-money option should trade at the same price as if you wanted to go and just simply put the position on margin. So as a result, option prices get bid up as we get closer and closer to that strike price, where the deltas expand dramatically. Again, this is another very unique feature of options, but because they have that extra premium built into them, they have to reflect the cost of margining the position. If they don't reflect the cost to margin a position, what does that open the opportunity for? If options do not reflect the cost of margining a position when they are at the money, it opens the potential for arbitrage opportunities. In essence, you could go margin the position on and then simply sell the option. Or vice versa. You could open a margin short position and buy the option. In essence, it would create a zero-sum game. And if those numbers are not exactly the same, then the arbitrage guys will just pocket the difference. So because of that, ironically enough, as options go from at the money to in the money, we actually see the deltas actually come down. The rate of change of the option actually has to start losing some of that sort of margin value, and it has to go to just simply reflecting its intrinsic value. So as a result, the rate of change of the option actually gets lower as we go from at the money to in the money. Now, this is a very long-winded way to go around that. What do we call that change in the delta's behavior given its proximity to being out of the money, at the money, and in the money. What do we call the change in the delta's behavior as the option goes from out of the money to at the money to in the money? And gamma. Very good, guys. Very, very good. All right, so that is actually summarized really nicely in this image. And I would highly suggest, the interesting thing is, you could have been sitting here just looking at this image as I was going through all of this conversation. It's actually kind of, what do you guys think? It's kind of difficult to verbally explain this change in behavior in options prices, eh? Did I do a half-decent job there verbally talking through all this? I hope I did. But in essence, this green line, and it's reddish, orangish for puts, this is the delta of your option. And as the option goes from out of the money to at the money, and of course it has to reflect how to, the cost to margin the position. Let me ask you guys this. And we'll look at the calls just in particular here. What is the intrinsic value of an option that is at the money? Exactly at the money, at its strike price, right on the nose. What is the intrinsic value of that option? We said that the deltas expand, the price of the option goes up. It has to reflect how much it costs to margin the position. The intrinsic value of the option at the money is 0. Well, so that's theta though, right? So 0 is the intrinsic value. The time value is called what? Intrinsic, I guess, is 0. Very good, Center. You said so 0, and the question was, what is the intrinsic value? This time value, if there is any on the option, is called what? It's not called intrinsic value. Theta. Very good. All right, so I just want to make sure you get that clear, Center. So way to go. Okay, so the point of the matter here is that there's a whole bunch of premium built into these at the money options. And as we go deeper and deeper and deeper into the money, that margin arbitrage trade has to come out of the option. And so that's why the rate of change of delta actually goes down as we go deeper and deeper in the money, or gamma. In essence, gamma, the first derivative of the rate of change, gamma rises, of course, as we get close to the strike price. And then once we're at the strike price, gamma has peaked, and now gamma actually starts to fall as we go deeper and deeper in the money. And you have to understand this about options. It's critical. Okay, there is one more Greek that we've left out. Who can tell me what that is? There is one more Greek that we have left out. What is that? And everybody's feverishly looking through their notes. What the hell? Which is the one that he didn't talk about? All right, Vega. Very good. Vega, and look at your, if we look at deltas here, Vega should become kind of intuitive. Does it make sense that, this is a calls, the calls are above and the puts are below? Vega here, or your sensitivity of your option, is really going to be non-existent if it's really far out of the money. But as we get closer and closer and closer to that strike price, your sensitivity of the option starts to come to life. Does that make sense? Think of Vega as the come to lifeness. You actually start to see it moving around, and people start trading it, and the bids and offers start moving. Over here, nobody's going to be interested in your option. But as we get closer and closer to your strike price, that interest will increase. Now, also remember too, Vega is highly correlated with theta. So as a result, an option that has a lot of time on it, massive theta, it will be more sensitive the further we go out on the curve. And that is basically what this image is. So here we have two different options. One that has a longer maturity and one that has just a very little bit of life left. And I need for you guys to be able to understand that the sensitivity of the option that has a lot more life in it is going to be much greater than the sensitivity of an option that is getting close to expiry. Does that make sense, guys? Somebody give me some love in here. What do you think? Does it make sense that the Vega will be greater with the more time you have on your option? And of course, you know, somebody earlier had mentioned that long-term players, you know, guys that, oh, what's that? A kiss. Oh, you throwing me some love? Is that what you're doing there, James? You're such a sweetie. Theta or Vega, of course, on does it make sense that, well, let me slow down here. We had said earlier there's one particular option that option buyers, position traders, people that want to take positions in options use, and those are the LEAPs, the long-term equity asset participation securities. Does it make sense that those LEAPs are they're going to be much more sensitive to price movements of the underlying versus something that's going to expire in the next week? And, you know, I often found this as options came closer and closer and closer to expiry. You know, if you hold an option into expiry, you'll see it in person. The option will just be dead. And then all of a sudden, as the underlying price comes closer and closer to your strike price, then all of a sudden the option wakes up. Versus the longer dated options, they're going to be much more active. So it's really important to understand Vega, of course, is tied closely to both the amount of time that's left on your option and, you know, where are we on this delta curve? Does that make sense, guys? Sure hope so. All right, so we've covered the 5 Greeks. We said that the culmination of those 5 Greeks creates a basis for valuing options in the marketplace. What do we call that model? And, you know, if you take any options course, you have to know this. Put all those ingredients together, and there is a common model that's used to value options. What is the name of that model? Excellent, Center. Nailed it. Excellent, Dave. Excellent. Oh, you got Black Scholes? No. Don't forget the C. Mr. Scholes won't be very happy with you if you do. I'm just kidding, guys. You're awesome. So the point here is that these are fairly common principles. It was really cool, you know, when we went through the last class in the last tutorial session, somebody was like, Brian, here's a Black-Scholes options calculator model. Can you tell me how it works? And I'm like, I don't know how the fuck this thing works. It's just, this is the model. Which I personally found amusing. But nonetheless, I'm not going to bill myself as an options Black-Scholes specialist and an options calculator specialist. My job is just to simply teach you this guy's stuff so you understand. And now if you want to go and become a Black-Scholes expert, hell, I could probably teach a whole course on that in how we go about the options modeling practice. That's probably a little bit beyond the scope of this introductory course to derivatives. And it's actually kind of cool because Julian is working feverishly away on his option spreads module. And I think we might even do sort of like a maybe even like a derivatives part 2 course. And maybe in that course, maybe we'll dig into black squills a little bit deeper. But that's for down the road. I would consider this course here just to be nothing more than just your introduction to this space. Yeah, maybe a level 4 course, Philip. um, and really, what I just want you to take away from this is, the risk-free rate to borrow, the time value left on your option, the delta, the gamma, and then the vega go into basically the black skulls model. Okay, a couple other review points here. And sadly, this kind of trips up the public quite a bit, and you feel a little bit sad for the public because it's almost like the industry sets them up for failure. In that there's two really important concepts that we need to understand about options that happen to have exactly the same first initials. So we do one of the options concepts with a small IV, and then we do another one of our options concepts. And before we move on, let's who can tell me when we see lowercase IV, what are we referring to? And of course, we already talked about this, so everybody should get this answer. If we see lowercase IV, what are we talking about? Thank you, Center. Intrinsic value. Now, we said that options have to reflect, at the money options have to reflect the margin cost to strap on a position. And there is zero intrinsic value of an at-the-money option. So what do we call that injection of that options premium price into options when they're at the money? There's got to be a name for that. And hint, 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 it's when you see capital IV. Who can tell me what that capital IV stands for? Very good, Center. Implied volatility. And as we had sort of talked about before, really option writers want to try and capture that implied volatility premium that's built into options prices when we're at the money. All right, so we've talked a little bit about the Greeks. We've talked a little bit about intrinsic value. We've talked a little bit about implied volatility. We've talked about how you put all the ingredients together and it should come up with a model for what your option should be trading at. Now, it's really important to understand with options, are options a controlled marketplace? I think that's really important that we just distinguish that right from the get-go. Is there any sort of guarantee that options prices should be any particular price? And this is really important to understand in options. And Philip says no, and Philip is correct. Options, in essence, basically trade purely on what the public is willing to pay for options. And so as a result, does it make sense that during sort of FOMO periods, fear of missing out, assets are going parabolic straight up? Oh my God, I'm going to miss out. Are we going to see high implied volatilities or low implied volatilities? Remember, there's no magic formula that says an option has to trade at a particular price. It is entirely open marketplace. All right. And then conversely, if there's very little interest in the marketplace. FOMO should be another Greek. Not a bad comment, Center. If there's a relatively low interest in the marketplace and an asset really isn't that volatile, would we expect high implied volatility or low implied volatility? The answer I'm looking for, of course, is low implied volatility. Thank you, Center. So the point here is that because options are an open marketplace, and have any of you guys ever seen options trading? I mean, it's frantic. I mean, you think, crypto and stuff moves fast. You think like the New York Stock Exchange with like the guys walking around on the floor and stuff. You think the futures markets are fast? Oh my goodness. You should, in fact, I should probably try and find a video of the Chicago Board Options Exchange during their frantic trading. It is absolute chaos. And the sad part about it, hopefully you guys remember from the level 1 course, when we went and priced insurance policies. Keep in mind, options are there. There is no set price for options. They move based purely on perception of value. And hopefully everybody remembers from our sort of level 1 conversation that really that's what this is all about. This is the Chicago Board Options Exchange Volatility Index. Does it make sense, guys, that basically through, stock market's been coming off, that through this period of the stock market coming off, that implied volatility that we talked about just a moment ago is getting bid up higher and higher and higher as stock prices go down. In essence, that FOMO of, oh my God, the stock market's collapsing, I better go buy some insurance, has bid prices for options up dramatically. I hope you guys can connect the dots here. And, clearly put, do options buyers want to concentrate on down here, low implied volatility, or do they want to concentrate up here, high implied volatility? And the answer clearly is they want to concentrate on low implied volatility. And conversely, if you are a writer of options, you want to concentrate on high implied volatility situations. If you write the option, you want to collect absolutely as much money as possible from the deal, right? Hopefully does that make sense to everybody? Think back to our house scenario. If there really wasn't that much interest in doing the deal, Raf could buy my option. Remember, I was going to write him the house option. $200,000 was the strike price for $5,000. One might argue, and hopefully you guys can sort of follow along the thinking here. If there are 4 or 5 people banging at my door, my front door, and they're all like, "Hey, Brian, I want to get on this action. I want to buy that option." Remember, originally Raf and I did the deal for $5,000. Maybe one guy at the door will say, "No, wait, man, I'll pay you $5,500 for that option." Then the guy beside him goes, "Fuck that, I'll pay $6,000 for that option." And then the guy behind them goes, "I want this house. I'll pay you $10,000 for that option." Do you see how implied volatility works? I mean, the interesting thing is that's a really good, simple scenario of how implied volatility premiums can get bid up through a FOMO situation. Okay. A little bit of a side there. Okay, so I think we covered the basics of our review here. We talked a little bit about the Greeks. We talked a little bit about black skulls. We talked a little bit about implied volatility versus intrinsic value. I always like to throw these out here. Let's see if you guys can answer this. If I bought an option, let's say I bought an option and I was only allowed to exercise the option on the expiration date, what kind of option did I just buy? What style of option did I just buy? European. Very good, Philip. And if I wanted to buy an option where I could exercise at any old time I want, what kind of style option is that? And again, this is just purely review. We just want to make sure that you have these terms down cold. I'm going to buy an option that I can exercise at any old time I want. It's an American style option. All right. Okay, so let's see. I think we did some good review here. I think actually we might even do this next week. I think let's move right on into our sort of first key. Yeah. You know, a lot of this stuff we're going to talk about next week, so I don't really want to derail you too much here this week. I will say one thing that's important here, though, is, you know, first and foremost, well, I mean, okay, fine, let's just go through this. So first and foremost, we talked about this just a moment ago. If I was a writer of options, I want to concentrate on high implied volatilities. I want to write options up here. If I am a buyer of options, I want to buy options with a low implied volatility. And you could make the argument that one way to see that is through sort of the sensitivity of options. In essence, if I'm a writer of options, I want to capture what they call vega, right? I want to, in essence, wait for the option to become nice and frothy and people are bidding up like crazy for the options. The options are all hopping around, lots of volume. Those are the kind of options I want to write. It's important to remember too, especially when we go through the mechanics of these next two strategies, that a lot of people that do derivatives trading actually want to take delivery. They either want to have, if they wrote a call option, then they want to have the person who bought the option off of them, they want to have the option exercised so that they end up selling the stock, or, you know, in my case, the house, to RAF at whatever the strike price is. And it's important to remember that the delivery of options is not cleared through a stock exchange. The delivery and the exercise of options are done through the clearing corporation. And so as a result, the actual settlement of the options is all automatic. And I think Raf learned this the very hard way here. About a month ago, he got himself into a little bit of hot water because a market that he had an open options position on, they actually moved the market to the position being at the money, and the exchange automatically cleared the transaction on him. I don't think, Raph, you don't have 1,000 pigs running around your backyard, do you? There he is. If you want to learn about Raph's experience, just sheep. All right. I'll let you PM him, and if he wants to talk to you about his experience in getting automatically exercised, he can talk to you about that. But if anything, it's not actually bad that we actually have somebody on the site that went through an automatic exercise, because he can actually teach you from personal experience, like one of our TAs. Of course, you know, as an options broker and as an options trader myself, I've been through this, but it's weird how I kind of sort of poo-poo this because, you know, I've been doing this for 20, 30 years. It's actually really cool how we actually have, and cool or not, you know, I'll leave it at that. But, you know, Raf's got a very interesting story. And maybe, I don't know, Raf, are you going to be around for Wednesday's session? The Q&A session? Maybe we could even have him talk to the group a little bit about his automatic exercise experience, because it definitely put a couple gray hairs on his head. I know that. Okay, so if anything, maybe make a note in the homework guide. If Raf's up for it, we'll spend 5 minutes, 10 minutes just having him tell us his story. The second thing that we need to understand here is that, and what should happen is everything should be cash settled. We actually don't really, we don't really actually live in a world where you're going to get 1,000 pigs to your doorstep. What you're going to get is you're going to get like a line item credit or a line item debit in your account showing the transaction. And of course, when we talk about some of these transactions coming up here today, we're going to be talking about how they cash settle. We should also understand too that there's, there's actually, having an open short position on a margin account is subject to interest. And having open long positions on a margin account is subject to interest. Whereas either being long the put or long the call is a straight, you buy the position, that is the maximum amount of money you have to put down, and there is no interest consideration. So a lot of people like to play options because of that simple fact that, remember we had said, an at-the-money options position should trade the same as strapping on the margin. But remember, if you carry a margin position, there's going to be an interest charged against that. And what we actually find, in our second strategy that we're going to talk about today is that cost to carry the position on margin, the interest is actually really important to a lot of these option writers. We talked a little bit about naked positions. Having a naked call position is extremely dangerous. In essence, unlimited loss potential. And unfortunately, I do remember, well, this is slightly different, but guys who were trading things like pharmaceutical stocks, I guess about 5 years ago it was. Martin Schrekel. You guys remember Martin Schrekel? I think his name is Martin Schrekel. But anyway, he was he was in the news quite a bit about buying beat up pharmaceutical names and then jacking the prices up substantially on their drugs to basically boost the stock price. And, those are great examples where if you had a short call position on that trade, you could literally lose everything. You could be bankrupt. And of course, somebody also mentioned just a few minutes ago about the natural gas play. I'm not quite sure if that was a bullish or bearish trade, but one could argue that that natural gas trade, if he had open calls and natural gas prices went zooming higher, that could be unlimited risk as well. And then, sort of like our house scenario, if I didn't own the house and RAF did buy the option off of me, and instead of a golf course being put in the lot next door, maybe a really fancy exotic resort was put in next door, and the prices of houses didn't go from like 200,000 to 300,000. They went from like 200,000 to $1 million. Well, if I didn't own the house, Raf's going to be like, well, Brian, where's my goddamn house? I want to exercise the option. And now they're at $1 million. So that means you got to go buy the house back at $1 million and give me the goddamn house. So, we have to understand that naked positions in options are extremely dangerous. And it's, frankly speaking, it's not in anybody's interest to do naked calls. We will talk later on about what they call cash secured naked puts, where you actually have the intention to buy the stock. So as long as you have the cash in the account and you have the intention to buy the stock, a naked put isn't the end of the world. But naked calls are extremely dangerous. All right, we talked a little bit about interest rates there affecting, both what the margin cost is to carry an open position, But we're going to get into interest rates and the conversation about the effect of interest rates on options when we talked about our second strategy here, and why a really, really low interest rate environment actually works out to option put writers very well. Okay, and we'll be reviewing all of this next week too. There are a bunch of other sort of key considerations that I want you thinking about here with regard to options. I'm not going to get into net credit spreads here today too much. We don't talk too much about spreads in this particular course. I introduced you to them very basically, and I also introduced you to that Tasty Trade site. I hope some of you took advantage of the Christmas window to watch a few of their videos. And then also too, Julian's planning on doing a spreads module that he's still working away on. And so I think I'm going to leave the credit spreads conversation for another day. It's a totally different topic, so I'm not going to necessarily get into that today here. Okay, so let's get into the two main strategies I want you to take away from this short option strategy module. The first is a very, very popular strategy in the marketplace. And most people that participate in the options writing business, this is what they do. It's called a covered call strategy. And it works best for those people that own stock that doesn't pay a dividend. You know, like in this particular case, we have ALDR. I think this is a pharmaceutical name, right? Alder Biopharmaceuticals. A lot of times the biotech stocks, if they have cash, they'll just simply reinvest the cash into R&D. So they generally don't pay dividends. But at the same time, too, you can see how expensive this stock is, you know, $20, $30, $40 a share, $50 a share at the top here. So, you know, if you are a shareholder of this asset, you know, your brokerage account looks great. You know, you could maybe even take the stock to your banker and say, hey, can I borrow against the value of this stock? And a lot of people do that. They use, you know, blue chip stocks as collateral for loans. But, you know, that's assuming, of course, that you have a banker that's willing to take that as collateral. And that's a bunch of work unto itself. And you need a half decent amount of money to make this worthwhile. You know, if you have $10,000 worth of stock, it's probably not worth your while to go through all the paperwork and headache of taking out the loan. So the question here is, if you own a stock that's got some value to it, but doesn't pay a dividend and doesn't really have any plans to pay a dividend, how can you make an income off of owning that stock? And that's where the covered call strategy comes in. In essence, you know, here is the metric of the covered call strategy. As you can see here, there's three scenarios here. You know, if this is basically the stock, and as it moves up over time, right, it's just going to move one for one in a linear fashion. You know, every dollar it goes up, my account balance goes up. And then here, of course, is the call option that if we have a $50 strike price, in essence, the option, you know, obviously it doesn't move exactly like this. We know, you know, deltas and Greeks and all that. But in essence, only at $50 will the option actually have any intrinsic value. So what ends up happening here with the covered call strategy is as the market moves up to a certain level, if you write that option, then in essence, you collect this income much higher than this blue line. You're participating along this red line. And then as soon as you hit the strike price, because you wrote the option, and then, of course, think of our house scenario. At the strike price, now, basically, you expect for the option to be exercised. You expect the stock to be called away from you. That's where they get the term call option. The stock, in essence, the person who buys the option off of you calls the stock from you. That makes sense, everybody? You probably should know that vernacular going forward. That's a very popular term. So what does this mean? What it means is, like, if I own this stock and I was expecting it to just sort of bump around in a range here for a while, and let's say we did it through here, because the stock doesn't pay a dividend, I own the stock, and so in my account, it just shows, yeah, your net credit, 1,000 shares of whatever this stock is, and in this particular case, $30, right? You're a $30,000 position, but it doesn't earn you any money, and it doesn't earn you any interest. If I go and write an out of the money call option, does it make sense that I am collecting an income off of that action? Remember, think of RAF in our house scenario. Remember we had said that if I own the house and instead of a golf course being put in, a dump was put in. And so as a result, real estate prices in the neighborhood actually fall. As the house owner, I collected that income of $5,000 from RAF, and I never sold my house. I still own the house. So think of the covered call strategy in the same way. So in essence, in this particular case, you can see $50 strike. I'm going to, with the stock sitting, down here, $30, $40, whatever, I'm going to write that $50 call, and really, through here, I would be tickled pink if somebody came to me through here and said, "Oh, Brian, I'm more than happy to buy the stock off you today for $50 a share," right? Stock's sitting at like $30. It has an M top working. Oh my God, I want to get out of this thing, right? And somebody comes along and says, "Yeah, I'll buy it off you for $50 a share." So fine, I'm happy with that. The bottom line here is that if I go and write that $50 call when the stock's sitting in here, what I'm really saying is I'm going to collect my income from writing that option. And if the stock gets bid up to here, well, great. I get to capture this massive capital gain as well. Awesome. I'm more than happy to sell my stock way up top here. Thank you, Center. Yeah, understand that every option on the stock exchange is on 100 shares. So this happened to be a situation, ALDR, where the stock's sitting 51.75. And look at these option premiums. Now, does everybody see how the stock is going parabolic up here? Big bull move. Woo! What did we say should happen through these big bull moves to things like implied volatility? Does implied volatility go up or does it go down? Yes. Okay. What does implied volatility do if the stock goes parabolic like this? Implied volatility should go up. All right, well, let's go take a look at these options and let's see if this makes sense. On this date, 51.75 stocks up 82 cents on the day, 1.6% rally, July 2nd of this particular year. There it is, big move. If we go and look at something like the $50 call option, how much intrinsic value does this $50 call option have with the stock sitting at 51.75? It should be a really simple question and answer. $1.75. And do you guys see the $50 call here is sitting last traded $5.30. It's bid $4.10 and offered at $7.30. What do you think? Is there a bit of implied volatility built into that option price? Anyone? A bit, eh? Let's go out of the money. Let's look at this $55 call option. The $55 call option has how much intrinsic value right now? Stock's 51.75. The $55 call option has how much intrinsic value right now? Absolutely bud kiss. Zero. Now, keep in mind, this is an August option. This option expires in less than a month. Look at the price of the option. It's $3.50 bid, $4.20 offered, last at $4. Do you guys see how ridiculously high priced this option is? And why would that happen? And the only answer is because people think this thing's going to the moon and they're panic FOMO buying. Does that make sense? Now, the key here is if I own the stock, now try and see if you can wrap your head around this because it's really important. If I own this stock and I wrote the $55 call option and I collected that $4, what is my break-even price on the trade? If I write this option and collect the $4, at what price am I actually going to be selling the stock at? It's a $55 call. I'm going to be exercised if this stock goes up to 55 bucks. But remember, so that means somebody is going to buy this stock off of me at $55. But remember, I collected $4 in premium. So what is my real selling price for this stock here? You guys are taking wild shots. Nobody's got it yet. Hey, there's Center. Well, there, way to go, Center. You got it, my hero. I'm going to, remember, I already own the stock. I'm going to write the $55 call. So that means, remember this scenario here, stock goes up, and this happens to be 50, but let's assume this is 55. It's not really that big of a deal. I'm going to write the $55 call and collect $4. So that means at $55, the stock's called away from me. My profit is, of course, the $55 that I'm selling the stock at, plus the premium that I collected. Think of our house scenario. If I wrote the call option for RAF at $200,000 strike price and RAF pays me $5,000 premium, and then RAF goes and exercises the option at $200,000, how much money did I actually realize on the deal? Super important that you understand this. RAF, 205,000. Thank you, Casey. Excellent. Does everybody understand Casey's thinking? Well, no, only at expiry, Center. If the stock is in the money, remember we had said, if the stock is in the money at expiration, then the exchange will automatically exercise. Talk to Raf. He went through this in glorious Technicolor. And, you know, just wait for Wednesday's class and he'll tell you all about it. But remember, these are American style options. That means that the option purchaser has the right up to expiry to do something, but they're not obligated. And then we might find that at expiry, the price actually comes back down and it comes out of the money. That happens. So the point here is that if I own the stock and I wrote the $55 call and I collected this $4 in premium and the stock is exercised and it's called away from me at 55 bucks, my actual selling price is $59. And what do you think? Would that be a respectable capital gain from this $55? That's like almost about a 15, 17% premium over the closing price. Not a bad deal, eh? Even up at these lofty levels. What's fascinating, now remember we said that implied volatility premiums, right? Does that favor the writer or the buyer of the option? Inflated volatility premiums, does that favor the writer or the buyer of the options? The writer. What's fascinating about this is these premiums get bid up so much. The irony of all is if you actually did this deal, watch what happened to the stock. This is July, right? We said July 2nd. And I think this is 2015, right? Yeah, 2015. It turns out that the stock, literally, that was the top. And shortly following that, the stock actually collapsed. And you notice by the middle of August, that option expiry, you see how the stock never would have been called away from you. In essence, this was exactly the point. And remember that even if this option was exercised by the person, which would have not been a very smart idea, right? Because it was a $55 call. So there never really was incentive for the guy to actually exercise the option. But remember, by me writing that option at 55, I actually ended up, if the stock was actually called away from me, I actually ended up selling the stock up here at 59. So it turns out that this was actually a pretty good idea to write this option up here. Do you guys see that? Isn't that remarkable? Quite stunning, really. All right, so the point of the matter here is that there are participants in the market that will hunt for these bid up implied volatility premiums. And this is the primary way that somebody who owns a stock, who the stock does not pay a dividend, can generate an income from owning this stock. It's called the covered call strategy. Right? So in essence, the option strategy where the investor holds a long position in the asset and writes or sells call options on the same asset in an attempt to generate increased income. The objective, of course, increased income reduces the cost basis and takes advantage of seasonality, right? Do we have any sort of expression, buy when it snows, sell when it goes? Have you guys noticed that the stock market sure seems to like to top out around the middle to the end of the summer? I mean, did anybody see what happened in the stock market there through the fall of this year? It's pretty normal. And ironically enough, this guy sort of, gee whiz, what a coincidence, right into the fall, it came back down as well. So you often see in the summertime a lot of options writing, covered calls. And really what I'd like for you to do through this week is I'd like for you, if you haven't already, to introduce yourself to this gentleman. He calls himself the blue collar investor. And I don't even know if this link works anymore. It's been so long since I've been out there. Here he is. And in essence, and really, you can take his course if you want. It's basically exactly the same thing I just told you about. But in essence, it's how you actually run this strategy. In essence, all he does is covered call strategies, taking advantage of these ridiculously inflated premiums. Now, of course, the issue here is you want to concentrate on assets that you do own. You don't want to do this naked. Maybe the stock takes off. And the math behind this is you want to make it attractive for you to be exercised and have the stock called away from you. Just like we said in our scenario here, I actually ended up, if I owned the stock, even at $51.75, I could actually just go buy this stock at $51.75 and write the option, write the $55 option. Now, who can tell me, this is sort of another key here. See if I can get this focused in here. If I buy the stock at $51.75 and I write the $55 call, who can tell me what my average cost basis is for owning this stock right now? If I buy the stock at $55, or excuse me, at $51.75, and I instantly go in and write the $55 call, what is my cost basis for owning the stock? You're close. We can pull up a calculator. Where is the calculator? There it is. So we say that the cost to buy the stock is $51.75. And we collected $4 in premium. We'll just say that we got filled at $4. That was us. So my cost basis to own the stock is $47.75. Does that make sense, Philip? $47.75. $51.75 minus $4. So if I actually go and get exercised and end up selling the stock at 55, right? Boom. I was exercised at $55. Then what's my profit margin? $7.25, right? Remember 55, that's, the straight stock transaction is what, $3.25 plus the $4 premium that I collected. $7.25 divided by 51.75 means I have a nice 14% return on the trade. Does that make sense? I buy the stock at $51.75. I wrote the option. So my average cost has been brought down by collecting the premium. And if I'm exercised at 55, then I pocket a nice 14% return on my money. Not a bad trade, eh? And of course, if the stock does go down, the option premiums will go down. And you could blow the position out at 41 at our cost basis, right? 40, what do we say? 47 or whatever. And just cover the position back, right? 47.75, that's our cost basis. And just go and, like I said, this option had like a month of time left in it. And you can even see just from one strike to the next, you can see how dramatically the option prices can fall. Look at this $60 option. It is offered at $340. Look at that. That's just ridiculous, eh? And I'm like no bid at all. Okay, so does this make sense, guys, as a way that people participate in the derivatives market by writing call options? Can you understand the logic behind this? Dave says yes. Philip says yes. This is great. All right, Shane. Awesome. Now, here's the scenario. Remember, these premiums get bid up because of that FOMO, right? Remember, implied volatility. Here's a situation where the stock is just collapsing. Is there going to be high implied volatility or low implied volatility? The answer, of course, low implied volatility. And so as a result, we look at the option prices and you can see this doesn't make any sense at all. Right? If I own the stock at $50.83, you can see even like, the $50 call right there. And really, I don't want to lose money. So, if I wrote the $52 call at $50.83, you can see the 52.5s are $1.50 to $1.61. So in essence, I'm going to get like $1.61. The stock's going to be called away from me at 52.5. And I'm going to collect what, $1.50, maybe $1.67 plus this $1.53. So that's like What do we say? $1.50. So let's call it $3.50. So $3.50 on a $50 stock. That means I'm only collecting like maybe about 7 or 8%. It will bring my cost basis down, right? 50.83 minus $1.53. That doesn't bring it down a hell of a lot, just down to 49. And so as a result, because the implied volatility premiums are so low, it's not really attractive. So it's critical that we go through the math and we try and find the scenarios. Like this is an interesting one. This option is what, $3.25 out of the money, and yet this option is like $1.50 out of the money. And you can see the huge difference in premiums. Why? Because this has a lot of implied volatility built into it. $3.50 bid, last of 4. This has no implied volatility built into it. $1.53, last at $1.41. So the key here, of course, with implied volatilities and doing the covered call strategy is we're looking for stocks that have been bid up and that have high implied volatilities in them. Yeah, that's also true too, but it's also, think of it too as the expectation of what's going forward. The irony of it all is that this might actually be a half decent buy. Good old TRI and teaching you to try and buy against lows and sell against highs. Ironically enough, and as we saw in this ALDR, going and buying this thing up here was a horrible idea. And yet, probably I haven't done it, but if we pull up this, my hunch is this thing probably did turn here. And being a buyer of this option here is not such a bad idea. So do you see the difference between high implied volatilities? We want to be writers of options. Low implied volatilities, we want to be buyers of options. Do you see how that works? And it's quite remarkable. It's not really like this is written in stone. Remember, this is purely up to the market. And, there's nobody standing there saying this option should be trading at this price. So why is it not, right? It's purely open to the marketplace. Does it make sense that if we ran the Black-Scholes model, Black-Scholes would probably give us almost no value for this option? It has less than a month left, right? It's July. And the expiry is the middle of August, so it's about a month or so. And it's deeply out of the money, so you can't even argue there's any intrinsic value. It's trading purely on implied volatility. Black-Scholes would hate this option. And in this case, same sort of thing. We don't have a lot of time, but at least this thing doesn't have nearly as much of a premium. Oh, did you grab the chart? Oh, yeah, look at that. The son of a bitch turned and went up. So there you go. Ironically enough, this was actually not a bad place to be a buyer of this stock. Isn't that incredible how that works? Thank you, Shane. I appreciate that. Okay, so for Wednesday, do you think you could all just go and introduce yourself to the blue-collar investor and just walk through some of his very basic, what are you saying here? If we write covered options, how do we prove we own the stock asset to the counterparty? Well, remember, and really, there is no legal obligation. Most brokerage houses will not let you write naked options. They just won't do it. You have to have the money in the account. And of course, remember that the brokerage house is on the line, right? The exchange is going to go after the brokerage house before they go after you individually, because the brokerage house is the one that they have leverage with. So what often will happen is, remember our scenario with the UBC professor who was writing the put options on the stock index and then the 87 crash. The options exchange went to the brokerage house and said instantly debit credit. Sorry, Brian, the expiry was in the middle of the chart, not the end. Well, just the point is that the stock actually went up. Say, if we're just talking about which is a better buy, ironically enough, this was a horrible buy, and this actually was not a bad buy, right, Shane? So, ironically enough, we can use the option premiums information almost the exact opposite as the TRISOF. If you do TRISOF on this, you're going to puke, right? You're going to be like, there's no fucking way I could buy this option. It's worthless. It's only got it's got like a month left of time. It has no intrinsic value, and it's trading at this insane premium. And this one, TRISOF, we wouldn't look at this anyway because it only has a month left of time. But the point here is that at least it doesn't have that insane premium. I might even suggest, if we wanted to, and keep in mind this is long strategies, we're talking about short strategies here. What I really want to illustrate is this is a great option right. This is a horrible option right. Does that make sense? I hope so. Okay, so that's strategy number one that I wanted to introduce you guys to today, called the covered call strategy, and it is a very popular way for people to get paid an income off of owning assets that don't have an income. And, when we pull up like CBOE open interest, we'll talk about this in a bit. I don't think well, do I? Yeah. We'll talk about this in a little bit more in detail when we're sort of reading the market and derivatives information. But a lot of retail business is done in writing call options because this is a very, very popular strategy. And if anything, for Wednesday, maybe see if you can go and find probably a lot of put options now have really insanely high values. And ironically enough, that actually speaks to our next strategy. So the first strategy we wanted to introduce you today was called the covered call. And it is writing call options to collect an income on assets that you own. We don't want to do naked. You're going to get yourself in trouble. But it's very popular if you own the stock to create an income stream off of writing call options. And, kind of like in this scenario, if you had written that call up here, odds are it would not have been exercised, and the option just simply would have expired worthless. And so in essence, had you owned the stock, you still own the stock, and you just pocket this $400 or $500 in income. The next strategy we want to introduce you to today is the writing put strategy. I first learned this strategy, actually, ironically enough, from my father, who he's an engineer. In fact, he was engineering physics. I don't know whether you guys know engineering physics, but it's probably one of the hardest university degrees to get. Extremely math, very, very challenging. And it's actually ironic that he was engineering physics because most of his classmates all went on to be university professors and stuff like that, right? They didn't actually really go into the working world or running businesses and stuff, but my old man was a little bit of an oddball. So anyway, he loved to crunch numbers. Electrically tied, yeah, sort of. Engineering physics it's a difficult degree to get, trust me. Anyway, the point of the matter here is he loved to run numbers. And what we have to understand before we get into that, I'm just going to tell you that my old man came up with the strategy. And actually, if you want to learn the history of the strategy, I used to run it on my old 1980s website. And I actually had built out a whole business that he and I were going to run. The question is, where the hell do I have it? I got it around here somewhere. Just give me a second. It's been a while since I've been back on this page. I've wanted to get this going on algos. Here we are. I wanted to get this strategy running on TRI, but we just haven't gotten around to it. But anyway, here is, for your reference, here is the write-up I did, and you are all more than welcome to go and read this if you want. But here is the business that we actually created. I'm not going to sugarcoat this. This is extremely complicated stuff, no doubt about it. You can see we did this back in 2013. And it's also predicated on the idea that interest rates, the cost of borrowing is extremely low. So what I'm going to suggest that you do is, and I wrote this webpage myself, so y'all look at it and go, holy crap, is that ever amateur? Sure, that's understandable. But I want you to go and read this report. And it's not a report, it's sort of an explanation of how this works. But I want you to both walk through why people do this, right? There is a very specific logic behind why market participants do the option put right strategy. And it has everything to do with the cost of maintaining positions. But first, before we get into that, we need to talk a little bit about market participants. So, as we said just a moment ago, the covered call strategy is very popular, right? If you especially directors, insiders of companies that get issued stock, they want to collect an income off of owning the stock. So the covered call strategy is extremely popular with the public. And if we look at, it doesn't really matter. If we look at any option series, this happens to be the S&P 500, right, SPY. If you look at any sort of option series, and I especially like to use the leaps to try and really see this. What you'll see is, let's see, where's the big contract? Here we are. You'll notice that on the left-hand side of your page, right, and this is CBOE, and hopefully you remember this from the sort of introduction, we have the call options on the left-hand side, and the strike prices all down the middle, and we have the put options on the right-hand side of your page. And you'll notice that, think of open interest as, Raf and I did our deal on our house. I wrote him the option. He bought the option. So what's the open interest on my house when it comes to options information? Anybody tell me? Raf and I did our deal. I wrote him the option. He paid me $5,000 premium for the option. What is the open interest on my house on options? That's right. One contract. So this is on the S&P 500 depository receipts, and it probably actually would be better. Why don't we pick a stock? Let's go like Microsoft. Right? Everybody knows Microsoft stock. Maybe Bill Gates or whoever, right? They get issued stock. Microsoft, I don't know whether they pay a dividend or not. I think they do now, but they did years ago. So a lot of people would be in here on the call side writing these call options to create an income on their stock. Does that make sense? Right? Let's assume Microsoft doesn't have a dividend. In fact, here, why don't we pick a stock that doesn't have a dividend so that way there's no misunderstanding. So let's go over here, and then we'll go links list. Somebody got a stock that doesn't have a dividend. How about actually, I don't think Facebook, they don't have a dividend, do they? FB. Dividend. Yeah. Okay. So Facebook's not a bad example, right? They do not pay a dividend. I own a whole crap load of stock here. Zuckerberg and I did a deal a while ago and I got paid options to directors, whatever, right? So I've got a whole bunch of my Facebook stock that does not pay a dividend. So the question ultimately is, how am I going to create an income? Sender says, what happens if there is a dividend? Do you have to pay back the dividend from the day that you wrote the option? The answer is no, absolutely not. If you own the stock and you happen to have an option that's overriding it, then the option price should change if the dividend is, if it's XD or if it's not. But you do not, the actual dividend payment is not reflected in the stock, in the option owner. If the option is exercised and you do the stock transaction and the stock is called away from you, then the new owner of the stock collects the dividend. Okay, so once upon a time, we've got January 2019 options. I own Facebook that doesn't have a dividend. I want to collect an income. So most of these people that you see on the call side, you know, this is the leaps, right? Maybe they wrote them a year or so ago, right? You can see a lot of open interest here. 49,000, 26,000, 22,000, 22,000, 39,000, 34,000, et cetera, et cetera, et cetera. The point I'm trying to make here is a lot of this business is the option writers of stock who own the stock, people that own the stock, right? Covered calls. Does that make sense? Hear me now and believe me later, or however that goes. Most of the open interest that you see along this pane here on the calls, right? This is the calls. Most of this open interest is covered calls. A lot of retail participation. Now, you know, there might also be speculators in here too. The point I'm trying to drive home here is, do you notice that the puts aren't nearly as thick as the calls, right? 30, 11, 14, 30, 49, 26, 28, 22, 39. This is a lot of open interest. We go over to the calls and you see, okay, 20, then we, you know, skip a whole bunch of strikes, then 40, then 18, then 40, then 20, then 11. Then look at how the open interest just dries right up here. And look up here. I mean, there's no open interest at all. Why? And the answer is that like 80 to 90% of all the open interest in put options is institutional. In fact, most retail clients are discouraged from writing put options. Remember, we had said a brokerage house does not want you to write naked positions. Now, it's okay if you own the stock and you write the call option, because worst case scenario, the stock is just simply called away from you. It's a very simple line item notation on the brokerage house, and the stock just gets transferred from your account to whoever it was that bought the call off you, right? Does that make sense? On the puts, however, there's no such thing as sort of, you know, I'm short the stock, and so I'm going to write the put, right? People don't do that normally. And, you know, in essence, if you write a put option, then really what you're saying is, I'm absolutely guaranteeing that I will buy the asset from you at a specific price, because remember, the put option gives the buyer the right to sell the asset at a specific price. So, rule number one, absolutely, without a shadow of a doubt, retail does a lot of call writing. Retail does almost no put writing. As we say in the slide here, 90% of all puts written are done by institutions. Industry would actually prefer to keep the public out of this side of the business. How do they go about doing that? Well, for starters, derivatives and the whole conversation about derivatives in the public is very negative. Have you ever heard anybody in the public talk positively about derivatives? And yet the irony of it all is, in a weird sort of way, through the level 1 program, derivatives are nothing more than insurance policies. Do we talk negatively about owning insurance on your car? No. Do we talk negatively about owning insurance on your house? No. In fact, it's actually a legal requirement. But for some reason, when it comes to the stock market and the speculative market, we talk about derivatives and everything comes under this massive negative sort of banner. It's all a scam and you're going to get wiped out. Why? Well, because of that idiot at UBC that is writing put options, and yet he doesn't know what the fuck he's doing, and he ends up almost blowing up his account. Are you going to go out and take out like 20 insurance policies on your car? No. Are you going to take out 20 insurance policies on your house? No, you only do one. But for some reason, when people come to the derivatives market and they start speculating and risking money in the marketplace, they end up, all logic just goes out the window. So as a result, industry is perfectly fine. They are perfectly happy with the very negative perception of derivatives in the public's eyes. And of course, the regulators, they want to keep the public out of this because they don't want university professors blowing themselves up. And so as a result, derivatives are vilified in the industry. Well, really, in public, for that matter. Secondly, it's actually extremely difficult to open up an options account. I used to be an options broker, and I literally used to work with what they call a drop, who is, every brokerage house has to have one. It's called a designated registered options principal, drop. And in essence, they have to approve any options account that's opened, and it has to be done manually. And 9 times out of 10, and there's one drop that I used to work with, he used to always say, no, 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 no. And it would be like, okay, well, we want to get this fucking account open. What do we have to do? Okay, you got to do this, got to do this, got to do that, got to do this, got to do that, got to do this, got to do that. They try and make it as absolutely difficult as possible. And even just me opening up my options account. All right, so Raf says here, you will be asked many questions to open up an options account, but it is doable. Interactive broker is probably the best. And, the bottom line here, just as Raf sort of said, is if you, and really sort of this is what I sort of said here, right? If you understand what you're getting involved with and you can jump through the hoops, then you actually start playing with the professionals. I'm not saying that everybody is cut out for this. And in actual fact, as you guys know, I don't even like to talk about options with the public. I don't like to even bring it up with the level 1ers because really they got no business even looking at this shit. And as Raf will tell you on Wednesday, it can get pretty hairy, right? If you let things slip, problems can develop. So the bottom line here is if you do get to the point where you can open up an options account and you can write options, you're now playing with the big boys. And what you have to understand is that the professionals in the marketplace use the derivatives market to actually set floors and ceilings on stocks. They don't necessarily have to go into the marketplace and actually buy the stock outright. But as you can sort of see here, by institutions, and you can see on Facebook, for example, right? The stock right now is sitting at 137.92. If we actually go and look where the institutions have the heaviest open interest in the put options, remember, The put option gives the seller the right to, or excuse me, gives the buyer of the option the right to sell the asset at a certain price. So does it intuitively make sense that the writer of that option, they're only going to write the option if they actually feel like, okay, that's a good buy. It's really important for you guys to connect the dots here. So if we know that institutions do most of the put option writing, then we should look at the open interest, and where they have the heaviest open interest will tell us where the institutions or the smart money feels as though there is a bottom in the stock and that the stock is actually a pretty good buy at those levels. Does that make sense? Super, super duper important concept for you guys to get. I'm going to take a minute and just pause here because it's really important that you get this concept. So give me some feedback here that you understand what I just said there. Casey says yes. Dave says yes. Center says yes. Shane says yes. Philip says yes. Okay, well, we got quite a few people saying yes, so that's encouraging. All right, so the point here is we can go and look at the put open interest puts. I like to use, things like the monthly options because you can see these weekly options. This expires the 11th. There's not that much open interest here. But you go down to, this is the big leap, right? And remember, the monthly options expire the 3rd Friday of the month. So the 18th of January, this is a really, really big contract because it's the leap. It's been trading for quite a while. And if we go and look where the heaviest open interest is here, you see 75, there's 27,000. At 100, there's 22,000. 125, there's 19,000. Oh, wow. 130, 42,000 contracts. Woo, 140, 47,000 contracts. 150, 48,000 contracts. Now, notice what happens when we go up here. Look how, as we're heading higher here, now 160, 170, 180, 190, 200, look how the open interest just collapses. No interest whatsoever by the institutions to write these options at all. So we look at where the heaviest open interest is, and you can see it's 130, 140, and 150. Does it make sense that between this area here, this is where the professionals in the marketplace believe there is value in this stock between 130 and 150. They are more than happy to buy this stock at those levels. And then when we go look at the current stock price, we see it sitting basically 140 bucks, 138. Do you see what I'm getting at here? And then if we go and actually look at the stock itself, we see that, gee whiz, it was up at 200, but as we're coming into expiry, the institutions are more than happy to be buyers of this stock right down in this area. And gee whiz, what a coincidence. Look where the stock stopped going down. Does this make sense to you guys? This is critical. It's no accident that the stock stopped going down as soon as we got below that 130 area. This is incredibly valuable information for market participants. Well, it goes beyond fortune telling because what we're really seeing here is we are seeing where the smart money has put the floor in the stock. It's not an accident at all that they just didn't have that much open interest up top here. That's not an accident at all. Remember, these are the leaps. These are the long-term options, right? Sometimes these things trade on like a yearly basis. And yet, why is it that the institutions have like no open interest? up top here, like a couple thousand contracts, big fucking deal. There's none. There's like no open interest up here. And yet for some reason, the public was more than happy to buy Facebook up here, $190, $200, $210. Stock gets slammed and everybody's like, oh, Facebook, it's over, it's over, it's over. And gee whiz, what a coincidence. Where did the stock actually stop going down? It stopped going down exactly where the big boys are long this thing. And it's interesting, the big boys are more than happy to be long. They're, you know, what's interesting, of course, is that these things won't get exercised unless they're in the money. So what do you think the odds are by January 18th? Remember, this is expiry, January 18th. What do you think the odds are, especially like this 1-4, or look at this, 135, 20,000 contracts. Whoops. Yeah, fudge. Didn't want to do that. Yeah. Hey, when you do this on CBOE, everything gets all screwed up. Sorry about that. Yeah, it's fine. 18th, here we are. What do you think the odds are that Facebook here will be just above 140 here on expiry date? Because remember, if expiry goes out, when you guys are saying 2018, this is 2019. If the stock goes out at $141, does this option get exercised? This is a put option. What happens to this option, this 140 put option, if on the 18th of January the stock is $141? This option expires worthless. So does it make sense, guys, these 140s and then also these 130s, 135? Does it make sense that Wall Street, because remember, they're the ones that wrote all these options, not retail. Does it make sense that by January 18th, it's in Wall Street's best interest, or whoever the market maker is, to make sure that the stock closes above this 140 level? Hopefully everybody here says it's definitely in their best interest, because if they can, all of these put options expire worthless. In the slideshow presentation, we showed you, here's an example of weekly options expiry. And this happens to be on oil. Heading into the expiry, we look at the open interest and we can see there's 300 calls and 900 puts. Here there's 400 calls and 1,000 puts. Here there's 1,650 calls and 800 puts. Now look what happens when we start going up here. Here there's 1,700 calls and 500 puts. 1,100 calls and 300 puts. And look at up here, 1,700 calls and 1 put option. Do you guys get the idea? And this is a weekly expiry, which is shocking, right? This is only a few days. Based on all of these puts, 500 puts, 800 puts, 1,000 puts, 900 puts. Can you see? And this is options expiry right here. Can you see how somebody came along and just kept bidding the market up to make sure that all of these put options expired worthless? Remember, institutions write the puts. These might be some retail, and that's fine. You can see that 1,100 calls, 1,700 calls, kind of a wash. 1,700 calls, my hunch is that somebody was playing a spread trade here. But the point here is, do you see how Wall Street doesn't have to worry about this put expiring in the money? There's only 1 put there. And here, they don't really have to worry. There's only 300 puts here. 500, 8, what does that say? 800, 1,000, 900. And remember, this is where the actual weekly option, this is Monday morning here. So in essence, Monday, Tuesday, Wednesday, they bid the stock up to make damn sure these puts do not expire in the money. And it's free money to the option writers. That's right, Shane. Do you guys get where I'm going with this logic? Do you understand how institutions, remember, it's super important for you to remember, institutions write like 90% of all put options. So as a result, as we head into expiry, we can look at where the heaviest open interest in the put options are, and we can get a pretty good idea of where they're going to want to take the stock out. Interestingly enough, and let's keep an eye on this for next week. In fact, why don't we do a screenshot of this? My hunch is by the 18th of January, they're going to rally Facebook here to above 150 here. I bet that they're going to want to take the market out like right in there. That would mean that this option, and this option will all expire worthless. Does that make sense, guys? In fact, I wouldn't even be surprised if they want to take it all the way up here. Wouldn't surprise me one bit. So let's keep this on our radar screen. And next class, somebody remind me to review this trade. Let's see what happens. I'll pin it here. And let's also take the Facebook. And let's say Brian says there is a large incentive for Wall Street to get this stock above $150 into leap expiry by January 18th. Well, we're going to have to, we won't see this play out, Shane, until actually the options expiry. So my hunch is probably our next class is when we should probably review this. We won't see this, right? The 18th is not next week. It's actually 2 weeks from now. Actually, that's kind of cool. So our next class is actually going to be that options expiry. So that works out pretty nicely. So if somebody want to remind me to, let's take a look and see what they did here into this options expiry. Okay. So we said that number one, most retail does not participate in writing puts. I guess we can go like that. There we are. We also said too that quite often institutions will use puts as a way to get long the stock. Think of it this way. If the stock right now is sitting 137.92, let's call it 138, right? Now, if I wrote the 140 put here for the big options expiry here, the 140 here. Well, actually, why don't we do this? Let's say I wrote the 135 put. All right. So right now, this option at 138 has basically about $2 or $3 of intrinsic value. So interestingly enough, it's sitting basically trading just at intrinsic value. There's no time value left because there's only a week or two left. And it's also in the money. So as a result, it has to trade less than well, I mean, it has to start reflecting that intrinsic value, and whatever sort of implied volatility premium has to start coming out of the price, right? And you can even see, I guess the stock must have had an update. This option basically fell in half. Do you see that? Okay, take it easy, bud. We'll talk to you. We'll see you on Wednesday, Zach. And of course, watch the rest of this video later. But can you see how these this put the day before yesterday was like $5. Actually, it was like $6. I mean, the put options have just collapsed in value. Let's see if we can do some math here. Let's say the average right price for this 135 put is, I did it again. Sorry. Well, actually, why don't we look at that? You can see it closed at $6.15. Who can tell me how much capital is on the line here in this option? And let's say the average right price is, I don't know, let's take half of that. We'll say $3. How much money is on the line in this one option? $3 times 20,000 times 100. So we'll say that the average right price is $3. Each option is on 100 shares, and there's 20,000 open interest here. We'll say roughly. Does that make sense that in this one option alone, there is $6 million of option premium there? $6 million that, market makers, they're hired to make the markets, so they're the ones that are going to be writing these puts. Remember, retail buys the puts, they don't write. So that means most of this is institutional money. Does it make sense that it's in Wall Street's best interest that if they can take this market out above 135 on the 18th, they simply pocket that $6 million? That's a lot of money. And if we go through the math here, you want kind of a fun assignment that'll sort of fry your brain. If you want to do it, it's up to you. Somebody tell me how much money is on the line just in this one contract expiry. Right? We looked at the 135s, right, with 20,000. That means, really what I would say, what part of retail is buying all those puts? Well, I would imagine it's all the people that bought the stock that are freaking out and trying to buy insurance. So back to our story. We can go on the, bigcharts.com. You've seen Thomas, but he did it in the daily brief, pulled up the bigcharts.com site where we can pull up the options charts of these. A lot of times I just like to say, well, let's assume an average right price of $1, right? Instead of these big fat numbers. If you want to pull up the options chart and try and figure out what the average right price of these are, that's up to you. But, we just did a really simple illustration with that 135. And we said that the average right price was like, what, $4 or $3 or whatever. You can go through and do the math on these, but the long and short of it here is what you should see is there is like tens of millions, if not hundreds of millions, if not billions of dollars, especially if we start looking at things like the S&P 500. If we start looking at like big assets like the Dow ETF and stuff, we're talking like billions and billions of dollars on the line here. So it's in Wall Street's interest to get these stocks above these heavy open interest levels. And what we often find, kind of like what we showed you in this slide, is that Wall Street will actually move the price of the asset up to make sure that these options expire worthless. They just want to simply pocket these premiums. DB link for preservation. Okay, thanks, man. I can just quickly show you. It's not really that big of a deal. If we go bigcharts.com. we were doing Facebook there, right? So Facebook. And we go options chain. And here is January. So we said the 135s. The only issue here on big charts is what expiry out here. Okay, I think this is the big one. And we got 135, and there it is, 235 or 253 down 3.5. And there's the chart. So you guys tell me, where do you think the average right price for this option was? You know, I don't really have a problem if you just want to average. And really the whole point of this is I just want you to get an idea of how much money is actually on the line with this option. And keep in mind, this silly option was trading at like $12, $13. What do you think? Was there just maybe a little bit of implied volatility built into these prices when it spikes up like this? I mean, do the math. Did Facebook actually go down to $120 a share? I don't think so. So the issue here, just simply put, is can Wall Street get the price of these options up so that these expire worthless? And it's in their incentive, they're incentivized to do so. Because if they can get the stock, like in this particular case, if they can get the stock to close at 151 on that expiration date, then this option becomes worthless. And who knows what the average right price there, 150. Let's see what those options are. I bet you they're even higher. Where do we do that? Over here. So what's the 150s? I mean, gee whiz, they're $12 freaking. Look at these things. They traded up to like $20. What is the average right price of this option? It looks to me to probably be about $10. You do the math, right? Remember we said $10 times 100 shares times, we said, what was the open interest there on the 150s? 48,000, 49,000. So 49,000. I mean, we're starting to talk some serious money here, people. $49 million. Would you guys like maybe one or two of those millions? Yeah. Set you up for life, eh? Just on one friggin' fraction of what these guys are doing here. So can you see this? There's quite a bit of incentive, $49 freaking million. And all they got to do is somehow just get the stock above this line here by the 18th. $49 million on the line. Can they get the stock to move up in a week? In 2 weeks, can they get the stock up there? Do you think they might even just go and buy a little bit of stock in the marketplace to try and ensure that that $49 million expires worthless? Well, now we're starting, you know, Dave, I would say think of derivatives. Remember TRISOFs, right? Derivatives we're getting into the mechanics of how the market works. I would say that there's a far higher probability that this trade will work. But remember, Wall Street, they are contractually obligated to honor this. So if the stock does go down here, well, that's fine. They'll honor it. But if they can get the stock up here, it's a major slam dunk for them. That's really what I want you to take away from this, right? This was 49 million bananas. That's a lot of bananas. $49 million bananas. And that's just that one strike. Okay, so I spent too much time on this. Point of the matter here, thank you, James. Point of the matter here is it's in, well, this is how Wall Street moves the market. Now, if we can, through all the hoops, get through the gatekeepers, can maintain the margin requirements of owning the positions, and keep in mind that when you write a put option, if you are a retail customer, and actually this will be a fun assignment, especially for guys like, I'm thinking of golden egg. Not Jacob. Who's Jacob's buddy? I've forgotten his name. Oh, geez, now I feel like an idiot. Jeremy, right? Jeremy was chief. That's right. Jeremy was all jazzed about, okay, Brian, I want to figure out options strategies. If you actually come up here and you come into the margin calculator, where is the tools? Maybe it's in here. Margin calculator. Here we are. Margin calculator. Now, I'm not going to, how do I do this? It's I guess Google doesn't like Flash, but anyway. If I write a put option, now keep in mind, right, this is for retail. When it comes to institutions, they play by very different rules. They do not have to follow the same margin requirements as the public. But if I let's see, maybe we'll make this like $100. And we'll say the option price is, I don't know, say $3. And the underlying price we'll say is, I don't know, $100. Okay, if I write this put, you'll notice, right, that I collected $3. But the margin requirement is going to be based off of the underlying asset price. So that means that I have a very, very steep margin requirement as long as this position is open. Why? Because the exchange wants to make damn sure, because remember, I'm writing a naked position here. So they want to make damn sure that if this thing's exercised, I've got the money in the account to cover the transaction. So if you can handle the margin requirements for writing puts, and obviously I wouldn't be writing this $100 option. Me personally, as we'll show you here in a moment, I like to, if I'm going to write options on these stocks, I like, $10, $20, $30 stocks, nice and cheap. But if I can deal with, the public hates derivatives, if I get by that. If I get to the point where, okay, the drop says I'm approved to open up the account. All right, great. If I can deal with the margin requirements of just while the option is alive, I have to have these certain margin requirements. Keep in mind, you're not spending any money. This is purely just a margin requirement that you have to have in your account. Remember, we had started this off with, this is what they call cash secured puts. So I have to have that margin money in the account, right, as my cash secured part of this transaction. If I can get through all of that, then we're actually presented some really interesting profit opportunities. The key here, of course, is that if you're going to write a put option, it's under the explicit understanding that you want to own the damn asset, right? Does that make sense? If I write a put, then that means the buyer of that put has the right to sell whatever the asset is. As the writer of the put, I am legally obligated to buy that asset. So we want to make damn sure that if we're going to write a put option on a stock, we want to actually be exercised. And then, of course, once the actual exercise happens, then all of this margin requirement stuff, it disappears. Because once the option is exercised, it's no longer an option. You now actually own the stock. And all of the nuances around owning stock prevail. Nothing to do with options anymore. So, first key of this strategy is we want to hunt for names that are trading at just insanely ridiculous value. Right? You guys remember in the level 1 course, we taught you the WDB model. In essence, we want to buy assets below book value. That sound familiar to anybody? This is in essence a deep value screen. We want to buy assets with a very low price to earnings ratio, but they are earning money. The key here, of course, is we don't really want to get into commodity related assets because maybe the book value of the asset is related to the commodity's value. And if the commodity itself falls in value, then the book value of the company is probably also going to fall. So we want to try and stick with companies that have earning streams and they're non-commodity related. Remember, we want to be shareholders of these companies. Remember what we said here. When assets are artificially, FOMO and wrecked conversation, does it make sense that if we looked at the put options on this Autodesk, that they would be inflated just like the call options were inflated on this massive bull run? Does it make sense that the put options on this stock would be massively inflated as everybody thinks this is going to zero? Super important point that you understand. So we want to actually hunt for inflated premiums on the puts, and this is the key to this. We're going to calculate the premium that we collect, and we want a massively inflated premium. And then we want to ask, what is the margin requirement from the brokerage house themselves to own the stock on margin? If the ownership of the stock on margin, what they're going to require for you to put up to control the position on margin, if it's less than what the premium collected, because the premiums are so inflated, then we actually have a very attractive trade. In essence, we write options where the premium collected is greater than the margin requirement to hold the stock. In essence, we get paid to hold positions. So, that's all well and good on paper. Let's see how it works in reality. This was a great stock because, and you guys have noticed, and the great part about it is now is the time to go hunting this shit in the stock market. I think probably for, at least 6 months, if not a year or so, it's in your best interest just to paper trade this shit. And guys like Zach, you do awesome paper trading. So I'm sure you're going to build out a really cool log of this stuff. This is a skill it's going to take time for you to learn and to become comfortable with. So I don't want to hear anybody going and spending money on this strategy right now. It's going to take time to learn this. But in essence, this was a company, and what a perfect name for a stock, right? This company was called A Perfect World. Isn't that a great name for a stock? Now, hopefully, I don't know whether you guys, and actually I'm going to fill my coffee up, so I'll be right back. All right, I've only been talking for 2.5 hours now. Oh, Jesus. Sorry, guys. Should probably try and wind this up. I actually have a couple other meetings I have to do here today. Okay, so this stock was called A Perfect World. And in essence, first things first, we want to find value. So look at that, how that's weird how that works like that. I can't zoom in, jerks. Nope, that's going the other way. Oh, well, I'll have to work off of this. All right, so this company, and you can zoom in on this when you're looking at it later. All right, there we go. That's better. At this price, and of course, we should all look at this price chart, and if this was an altcoin or something, hopefully all of us are interested, right? Looks like it's You know, where's the 50% rule? It's way up here. We got nice double bottom working, momentum's coiling. And look at the valuations. What do you think, guys? Current PE 4.9. Forward PE 6.57. Book value, it's trading at 0.89 cents on the dollar. Price to cash, it's trading at 1.62 times cash. In other words, they got a lot of cash on the books. And on top of that, they're actually paying you a dividend of 3.66%. Do you see how this is a fundamentally cheap stock? Do you see value here? That's the most important part of this, is we only consider stocks that are trading ridiculously cheap prices. And remember, we don't do this on commodities. So at this point, we've decided that we've got a deep value name and we really like to be an owner of this stock. Now, we could just go and buy the stock in the marketplace, and you can see it's trading here, what, about $11, $12 a share, right? This says here $10.48. Oh, no, I beg your pardon, $11.76. So we could go and just buy the stock, but it's going to cost us $11.76 times 100 shares. So, you know, at least $1,176 for 100 shares. Or we could go and write the put option. So what does that mean? We're going to pull up the options chain. And in this particular case, we looked at the $18 put option. Now, why $18? The $18 put option was written for $7.80. And that means that, you know, obviously the stock is going to be below $18 here. So, you know, sitting at $11.76, we're going to get exercised. If we wrote the option for $7.80, that means that we collected $7.80. And if we did one, $780. So that means that our cost basis for this stock is $10.20. Does that make sense, everybody? Simple math. Wrote the $18 put for $7.80. We're exercised at 18. We collected $7.80. So that means our cost basis for the stock, $10.20. Stocks on these major brokerage accounts, especially blue chips, trading above $5, options eligible. Usually the margin rate is 30%. So 30%, remember we're long from $18. That's what the exercise price was of the option. 30% of $18 means that we have to have in the account $5.40 to maintain the position on margin. Does that make sense? And it doesn't matter what the price of the stock is. The stock could be $25. The stock could be $5. The brokerage house wants 30% of this $18 value, or $5.40 in the account. No ifs, ands, or buts. So that means, remember, we collected $7.80. If we hold the position on margin in the account, we have to have $5.40 in the account. So do you see the difference between these numbers is $2.40? In essence, that's a premium over what it's going to cost us to carry the stock in the account. Or in essence, we're getting paid this extra $2.40 to hold the stock on margin in the account. Now, if you hold a stock on margin in an account, do you remember earlier on we said that you're going to be charged interest to carry that position on margin? So this strategy works great in a very low interest rate environment, right? Like right now, you know, Fed funds in the States is like 2.5%. You know, maybe brokerage house interest rates are 3.5%, 4%. So that means on $540, I'm going to be charged what? 25 cents a year, something like that. So in essence, I've got like 10 years of interest all ready to go to pay the interest on holding the position with this extra premium. Does that make sense? And this is at current interest rates. Keep in mind that back here, 2012, 2013, this, of course, was when they had to take interest rates to zero. So there was like almost no interest to carry this position. So, as I had said, I collect $7.80 for the put right. Now, I'm going to have to maintain a fairly high margin level in the account. Remember, we did the CBOE margin calculator. And we can, if you want, we can go through on Wednesday. I'm way over time here today. So I don't think I'm going to go through this exercise today. But if somebody asks, we could go through this on Wednesday. Jeremy, I'm sure you're going to ask. So ask on the Q&A document, and we'll go through the math here. But the long and short of it here is write the option, cost basis outright $10.20, but we carried this on position on margin. So our requirement was $5.40, and this $2.40 just went straight into our pocket as income. All right, let's see what happened over time. And, keep in mind, this isn't a bad place to own the stock, right? Remember, we're also getting paid, 3.5% dividend just to hold the paper. That 3.5% dividend might actually be enough to cover the actual interest that the brokerage house is charging us to carry the position on margin. All right, so what a surprise. Brian and his wonderful TA, the stock launches higher. Woohoo! Remember that this is basically the area as technicians we're going to want to sell the stock anyway. So does it make sense that as the stock is running up into our technical objectives, we go and sell the position? In this particular case, we sold half of the position on our double, same old, same old. We take the rest of the position off of the margin, and now we basically just have a free position in the account. And remember, that free position was generated by us getting paid to take the position and just hold it. We didn't even have to take any money out of our pockets. If you had went and bought the stock in the market, like we said, you would have had to pay $1,176 for 100 shares. In this case, we actually got paid $2.40 to hold the stock in our account. And then when the stock does its technical thing, which, we as awesome technicians and traders know that it was going to do that anyway, right? Now we got a free position. So in essence, we got paid to take the position. Now we have a free position. On to the next trade. Do you see how that works? Ridiculous. And this is how Wall Street plays the game. They actually get paid to take positions in stock. They don't pay any money out of their pocket. They get paid to play the stock market. Isn't that freaky? I don't know that that resonates with you guys, but most people, when I show this to, they go, holy shit, I can't believe how this game works. It's quite shocking, really. Really good example. If you want to go through and just simply walk through the math on this to try and figure this out, my suggestion right now, all of you guys, of course, the stock market's in the shitter right now, is we should probably be looking for these ideas. Well, so Dave, the key here, of course, is that, remember, rho, if we have, double-digit interest rates, then the margin charged on carrying the position is going to eat away on that premium that we got paid. And remember, too, that we're only going to consider put options that have their premiums ridiculously inflated. Remember, like on, it's important, going back to our call strategy, we would be concentrating. This is writing the calls. Does it make sense, Dave? Writing the inflated calls, you did really well. Buying the really cheap calls, not really that great of a deal. Same scenario here. Writing the inflated put options, awesome. Buy, we don't have it, I suppose it would be sort of this example. Writing the inflated writing the depressed put options on this would actually be a bit dangerous. And as we saw, the stock actually came down quite a bit. So the key to this, of course, is that we have to hunt puts that have high what? Let's see if you can connect the dots. Sort of summarizing everything that we talked about here today. If I'm going to be interested in writing a put option, what is it I have to see that's really, really high? Yay, Center. Oh, and you even did the fancy letters too. Very good, Center. I think Center's got this. We want, if we're writing, remember, if we're writing calls, we want high implied volatility. Do you see the high implied volatility here, Dave? Ridiculous. If we're writing puts, we want high implied volatility. And if you can get high enough implied volatility, then you can actually get the market to actually pay you to hold the position. And, Dave, probably a good idea. I think you should probably walk through this write-up. Can you do that for me? Dave, can you do this for me? I'll even put it in here as Dave's special assignment. Boom. Okay, why don't we leave today's class at that? As you can see, TRI's option leverage short strategies. Let someone else pay the bill. Do you get it now? Why, if we can find high implied volatilities, we can actually get the market to even finance ownership of these positions. It's a lot of fun. It's extremely dangerous. As I had said, the trap in option premiums is that the income is so quick and it's so easy that people often get in way over their head way too quickly. You want to just do this slow and steady and build positions over time. If you do understand how this works and you can wrap your head around this, this basically can pay the rest of your life participating in the market. Wouldn't it be nice? We could probably even start to work on this through Bitcoin's deribit options, but especially when it comes to, eventually we'll have an ETF, all that kind of stuff, right? When we get into FOMO situations and wrecked situations, and the market's just zooming all over the place and the implied volatility premiums are all over the place, this will give you but right now, what do you think? I actually think that with prices as low as they are, I'm thinking more WDB here on Bitcoin rather than covered calls right now. Right? Are call premiums super inflated on Deribit right now? I don't know. And then also too, we have to worry about those in European exercise issues as well. So, okay, so why don't we leave it at that for today? Next class, of course, we've got a couple things to review, so please remind me. And on Wednesday, we're going to have our nice little story about RAF, talking about automatic exercise on options. Next class, of course, will be sort of the summary of everything that we've done here. And then we're going to talk a little bit about other types of derivative products in the marketplace that you can consider as well. As I said, I've been going here for about 2 hours and 45 minutes, so I think I'm done. You guys all have yourselves an awesome rest of your day. I think we'll leave it at that. The only thing left to say at this point is a big bye for now.